What is real? How do you define real?
You can't jump into cash. Cash is trash. What do? You get out.
Vijay Boyapati is a former Google engineer who's interested in Austrian economics. Vijay is a husband and loving father, and he's the author of the Bullish Case for Bitcoin. Vijay, welcome to the Bitcoin Matrix podcast. How are you?
Thanks, Cedric. I'm great, and it's awesome to chat with you today.
Yeah, I'm so excited to connect with you. Your piece is very important to me. I really think back a lot to when I came across your piece, and it was very early on in my Bitcoin rabbit hole. And I probably was I probably heard you on a podcast, heard others talking on podcasts. That was kind of my format for learning. But it was really important to kind of hear something or read something without a voice in your head and just kind of get into the material. And your piece really spoke to me for several reasons. One being how, it's compacted into 40 minutes and it's jam-packed. I was reading through it for maybe the 12th time the other day. And I think I highlighted every word still. So it's a lot of material, but what was also important is it really helped me understand what the value proposition is here and what that meant to me, maybe more from an economic or financial or investment perspective. And a lot of this show is not really about investing, but at that point I was trying to understand, the asymmetry of this bet and the nature of this new tool and this new network. So, also I'd love to just, I did spend a month in Seattle. It's a great town, city. I love it there. So just kind of getting into the material, I'd like to just kind of, quote read the first paragraph and just kind of substitute one word. So with the price of Bitcoin surging to new highs in 2017, but we could just use 2021, the bullish case for investors might seem so obvious, it does not need stating. Alternatively, it may seem foolish to invest in a digital asset that isn't backed by any commodity or government and whose price has prompted some to compare it to the tulip mania or the dot-com bubble. Neither is true. The bullish case for Bitcoin is compelling, but far from obvious. There are significant risks to investing in Bitcoin, but as we will discuss here, there is still an immense opportunity. So my first question is, what long-standing problem did Satoshi Nakamoto solve with the white paper in 2008?
Yeah, that's a great place to start. So there was this problem in computer science known as the Byzantine generals problem. And it was a question of how do you coordinate in a distributed system when you have a bunch of parties who don't know each other, they don't necessarily trust each other. What's a mechanism they can coordinate with each other? And the problem gets its name from the idea of an army camped around a city, and the army's divided into subgroups, 3 or 4 subgroups, and they can't really communicate with each other because the city they're trying to conquer is in the middle, and it will potentially capture messages that get sent between them. And it will sort of act against these subgroups coordinating with each other. And the question is, how do they all attack at once so that they can take the city? If they attack the city individually, their attack is doomed to failure. But if they attack in a coordinated manner, then they will succeed. So that's where the name comes from. And so the problem in computer science is you have these systems where they're distributed across the internet, and you don't necessarily know people on the other side of the world. You don't trust them. What's a mechanism by which you can coordinate with them to achieve some shared goal? And Satoshi Nakamoto solved this problem using an ingenious use of proof of work. And proof of work is a system that was created by Adam Back in the late 90s. And it was originally created as a way to mitigate email spam, because in the late 90s, as email started to emerge as like a very powerful communications mechanism, people were just getting so much spam email. And Adam Back came up with this proposal where he said, well, when you send an email, what we should do is we should require you to do some amount of work, get your computer to do some amount of work, basically brute force grunt work, which doesn't really have any purpose, but has a cost. It costs you to do it. And that cost can be really tiny. It can be, say, 1 penny or 100th of a penny or something like that. So it doesn't affect your use of email because it costs so little, but it would affect your use of spam email. If you're a spammer trying to send tens of millions of emails to people around the world, it becomes cost prohibitive very quickly. So Satoshi Nakamoto used this concept of proof of work as a sort of foundational building block, but he used it in a way that no one else had previously thought about. And so that was the big breakthrough that came in 2008. And historically, it's kind of interesting. He sent an email to the cryptography mailing list and said, hey, I've created this new system for decentralized money. And the people on this mailing list had seen many attempts over the preceding decade of people trying to create money that had no centralized party and wasn't controlled by a government. And all of these attempts had essentially failed or had some critical flaw in them, which would make them impractical to be used. So Nick Szabo had BitGold, and Wei Day had B-Money. And so there's various attempts at doing this, but all of them had some critical flaw. But Satoshi solved the problem, sent a design to the cryptography mailing list, but the people on the list were incredibly skeptical when they saw Satoshi's first email, because firstly, no one had heard of him before. This was the first time he'd appeared. And just the history of really brilliant people, cryptographers and computer scientists trying to solve this problem, had yielded nothing over a decade. So the initial response to Satoshi's breakthrough was like, this doesn't work. And amazingly, even people now who are really important in the Bitcoin ecosystem, people like Greg Maxwell, they were really skeptical. They said, I don't think this is going to work. But ultimately, over time, as more and more people started using Bitcoin, using the Bitcoin network and trying to figure out ways to break it, we've figured out that the protocol that Satoshi designed, built on Adam Back's insight of proof of work, is actually very sound. It's beautifully designed, has a perfect balance of cryptographic guarantees and economic incentives that sort of pull it together to create something that was never possible before, which is decentralized money.
Right. And I think embedded in that protocol and the decentralized money is the new notion of digital scarcity. And without getting we can get into scarcity. I think we'll get into a little bit later. But if you could talk a little bit about scarcity and mining, and how maybe Bitcoin mining is similar and dissimilar to gold mining.
Sure, absolutely. So the notion of scarcity had never existed in the digital world before Satoshi Nakamoto's invention, and we all sort of have the idea that it's very easy to copy files and to copy images and transmit them, and how there's a lot of information that's kind of cut and pasted and moved across the internet very quickly. And so we understand that if you create a picture and you put it on the internet, someone could easily create 100 copies of that. So how do you create digital scarcity? And here, the big insight came from, I would say, Nick Szabo, who is a brilliant computer scientist and polymath. And he reframed the idea of scarcity not as being a property of there being a dearth of something, so a lack of supply of something. So typically we think of scarcity as like gold. There just isn't much of it, so it's scarce. Nick Szabo reframed this and said, well, you can also think of scarcity as something that's very expensive to produce more of. And that's true for gold too. So that definition also fits gold, but it's a reframing of that concept of scarcity. And using that insight, Satoshi Nakamoto designed the protocol in a way that it becomes increasingly expensive to produce more Bitcoins, so that eventually it's so expensive that the protocol is designed in such a way that no more Bitcoins will be produced after 120 years. So it's really this reframing of scarcity as the property of is very expensive to produce, that made it possible to create scarcity in the digital world where it was whereas previously not possible.
Right. Yeah, and I think also with gold, the notion that if gold goes up in value, yeah, they can create more through work, but they can create or alter the schedule of the output or the emit.
Absolutely. So yeah, that was the second part of your question, the difference between Bitcoin mining and gold mining. And yeah, that's absolutely correct, is that as the price of gold goes up, there's an increased incentive to mine. And really, the supply of gold is not limited in any meaningful sense. There's just gigantic amounts of gold buried in the earth. It's fairly costly to get it, but as the price goes up, there's a greater incentive to get it. So if you look at the history of gold mining, way back at the start of human civilization, you could kind of find gold in riverbeds very easily, just scouring to find gold. But as all the surface gold was obtained, people started digging deeper and deeper as the price of gold went up, and it became economic to continue to dig down for gold. With Bitcoin mining, on the other hand, it doesn't matter how much energy you expend, the amount of Bitcoin that's produced in a sort of unit of time cannot be increased. So that's a critical difference between the Bitcoin protocol and how it defines mining and gold mining. So Bitcoin produces something that's really never been seen before, which is ultimate scarcity. There'll never be more than 21 million Bitcoins. We've never had an economic good which had that property. It's always been, well, if it gets expensive enough, we'll figure out a way to get more of it. And that's certainly true of gold.
Right. Yeah, I agree. And if gold, Bitcoin, it's not a stock, it's not a bond, it's not backed by any physical commodity. What exactly is it? And how is the value sort of set for something like whatever this good is?
Yeah, so this is the part that most people find difficult to understand, because when people think about the value proposition of real estate or bonds or stocks, it's fairly easy to reason about, because these are based on discounted cash flow analysis. You essentially look at the cash flow produced by an asset and say, well, it's worth this much because over this period of time it's going to generate this much cash flow. Whereas Bitcoin is very different. It's a monetary good, and monetary goods are not valued by their cash flow because they don't have any cash flow. Gold has no cash flow. It doesn't produce interest or dividends or rent. And monetary goods are valued game theoretically. Everyone is looking for an asset to keep their savings in, a sort of a store of value that is valued by everyone else. And you're trying to anticipate, well, where is everyone else going to keep their savings? You want to keep your savings in the thing that everyone else thinks is a good store of value. And you're always trying to anticipate where people are going to move to, or in the future they'll keep their savings in that store of value, because you don't want to be the last in line if people have their savings in a store of value and eventually they decide, well, this isn't a good store of value. And so an example is silver used to be used as money alongside gold for a long period during history, but in the 19th century it was essentially abandoned as money. And the people who were holding savings in silver and using silver as a store of value actually lost a lot of their purchasing power, because most of that moved into gold at the time. So this is what we call game theoretic. You're trying to anticipate where everyone else wants to keep their savings and what will be the ideal store of value that's used by the rest of the world. So it's very difficult to reason about, because it's not some objective thing. It's kind of like a game that we're all playing, looking at everyone else, trying to anticipate how they'll behave. It's not completely unanchored, though. It's not completely a game. It's based on properties that make something good as a store of value. So you're not only just trying to anticipate how other people behave, but you're trying to do it based on what you know is the attributes that make for a good store of value, that other people will be looking at saying, well, this is a good store of value because it has attributes that are really good for that use case.
Right. Yeah, the game theoretical component was really something that was an aha moment for me. And it really kind of created a hinge in the way I was looking at a lot of things. So just kind of looking at everything as a trade and the opportunity cost of various things. But obviously, you know, with Bitcoin, you have this fixed denominator, so you can kind of use that one set of that one unit of measure across every item. So it really, the game theory thing was very interesting. I think we'll get a little bit more into that in a second, and opportunity cost. Kind of getting into like the origins of money and how, you know, money goes through different phases. How do collectibles serve as a form of proto money?
Yeah, so one thing that's really interesting looking at the archaeological record is that humans desired things that were otherwise useless. So beads and seashells and various things that ultimately became kind of a proto money. They were used as a store of value. They weren't used as money in the way we think about money today, where it's a medium of exchange use. You go to the grocery and you say, here, take my money and I'll get some bread or some coffee or whatever. They were used more as a way to transfer value between generations and between, say, tribes who are antagonistic with each other, but still had some benefit of trading with each other. And the thing I find most fascinating, you know, I've been studying money and the economics of money for a long time. The thing I find most fascinating about this archaeological record is that humans desiring these things that are otherwise useless, like seashells, provided us with a very important Darwinian advantage over our nearest competitor, Neanderthals, because Neanderthals did not have the same desire for these useless things. But that was a big weakness, because these things which are otherwise useless but are used as a way of transmitting value between generations or between tribes is a very powerful sort of means of social coordination. And so human societies were able to grow much larger and to coordinate in much larger groups, even if those individual smaller groups didn't trust each other. And that was a huge, powerful advantage that allowed humans to eventually sort of take over the world and essentially destroy their nearest competitor, Neanderthals. We don't have Neanderthals around anymore. So we as a species had this big competitive advantage because we had the ability for economic coordination. And it comes from this almost innate desire that humans have to value things that are scarce just because they're scarce, not necessarily because they're useful, but because they're scarce. And you can see this in young kids. Like when I was a kid, I like, you know, collecting cards and marbles and things like that. And it's like, why do I like collecting these things? It's just because they have there's this sense that, wow, this is potentially rare. And I see that my friends kind of think it's cool as well. So this is innate to the human condition, and it's a very powerful, innate biological advantage that we have to desire things that are scarce.
Very interesting. I love how you bring up the antagonistic tribes and the wealth transfer between generations. To quote Nick Szabo, compared to modern money, primitive money had a very low velocity. It might be transferred only a handful of times in an average individual's lifetime. Nevertheless, a durable collectible, what today we would call an heirloom, could persist for many generations and add substantial value at each transfer, often making the transfer even possible at all. This made me really think about wealth and building wealth long term. I think a lot about what Trace Mayer says about the 7 networks effects of money. And one of the things he used to talk about, I think in culture in India was, or that they really worship gold, and that they almost like pet the gold and they hold on to the gold, and you want to see or feel the gold grow bigger in your hands. And the whole point of that is to have the gold and not spend the gold. And so we've kind of covered scarcity there, and just sort of like, you know, the heirloom and you know, when you only make transfers over a handful of generations. But I want to revisit game theory and maybe opportunity cost. And I ask you, like, when people, you know, would desire certain objects or try to figure out what other objects other humans would desire, how did that play into like trade routes and merchants and, you know, different like currencies or different societies have different stores of values?
Yeah, so you had these societies developing, and each of these societies developed their own money, the thing that they use for social coordination within, their village or potentially sort of larger group of communities. But then as the world developed and trade routes developed, and you have these communities trading with each other, you have different kind of different monies coming up against each other, where you have merchants with who have to deal with both kinds of money. And really, I think these merchants were an important factor in spreading the use of the money that they had in their society into other societies. Because if you're a merchant, you really would like to see the adoption of your money in another society, because then that society adopting your money increases the value of your savings. The number of people who value the good that you're using as money increases your purchasing power. So you have an incentive to go in and trade with people and say, maybe I'll give you a discount if you use my money instead of your money. And this is kind of the part of the increasing network effect of money. You really want to use the money that everyone else desires. And slowly but surely, over time, over the millennia, gold became that global money, because people could see that it was widely valued and it's used in a lot of other societies. So merchants would demand that money. They would want to hold that money instead of the money that, they may have developed a kind of money in their society like seashells, but realize that not many other societies want seashells. So if you're a merchant, you ultimately want to hold the money that's used in the most places and the places that you trade with. So this is part of how I think the network effect of money spread over time through the merchant classes, which traveled along these trade routes around the world.
Right. Yeah. And that was also another one where I'm just kind of thinking over, like, again, trying to make choices and thinking about how you're competing against others for the best good that you think others will then also appreciate. So it's not just, a game or just your own opinion. So very interesting. And in game theoretic terms, what is Nash equilibrium?
A Nash equilibrium is a state at which everyone sort of adopts the same set of beliefs or the same money. It's when society converges on a single solution, which is game theoretic. So with money, you can have multiple monies competing with each other. And a Nash equilibrium would be when a society converges on a single one and everyone decides that's the one we want to use. And it becomes a stable system where you're not having this constant competition. And the benefit of reaching a Nash equilibrium for a store of value is that money acts as the foundation of all trade and savings. So if everyone is using the same money, that has a great benefit to society, because it makes it easier for everyone to trade. It makes it much easier for everyone to save, because you're saving in something that everyone else values. It's a tremendous boon for any society to have a single monetary good that's used by everyone in that society.
Yeah. And it was interesting, it kind of touching off on, the convergence on one store of value. Indeed, the 19th century was the first time when most of the world converged on a single store of value, gold. And this period saw the greatest explosion of trade in the history of the world. Of this halcyon period, Lord Keynes wrote, "What an extraordinary episode in the economic progress of man that age was. For any man of capacity or character at all, exceeding the average, into the middle and upper classes, for whom life offered, at a low cost and with the least trouble, conveniences, comforts, and amenities beyond the compass of the richest and most powerful monarchs of other ages. The inhabitant of London could order by telephone, sipping his morning tea in bed, the various products of the whole earth, in such quantity as he might see fit, and reasonably expect their early delivery upon his doorstep." I wonder, it seems like we're in that same place with Amazon and Disney and DoorDash. What do you make of that quote? And obviously you included it in your work. And how do you think it compares to what we're going through now?
Yeah, so the funny thing about that is the quote comes from Lord Keynes, and I really love that quote. I think it's a great observation about that historical period, the 19th century, which was really an incredible period. It was it was the period in history which saw the greatest increase in standard of living of the average person in the history of the world. It really tremendously changed the way that people could expect to live, and really brought a lot of people around the world out of poverty. I think the world has been moving towards globalization for several centuries, and there have been a few sort of hiccups or speed bumps along the way during the 20th century, where we had these, major wars which really broke the world into pieces, and different economic zones like the Soviet Union and the United States. But ultimately, I think there is always a tendency towards globalization and the world adopting a single currency, because that's just economically beneficial for everyone in society to be working on the same currency. The United States sort of came out of World War II as the big victor, and was able to craft an agreement which made the US dollar the world reserve currency. But I'm not convinced that that's a long-lasting situation, because in 1965, the then president of France, Charles de Gaulle, said, this system that has been created gives an exorbitant privilege to the United States. And it really does. The United States is able to get away with a lot by having the world's reserve currency. It can inflate the dollar. It can spend way more than it should be able to. So I just don't think this is a long-term sustainable system. And I think the world is going to move towards a currency which, as Charles de Gaulle said, does not bear the mark of any nation, and is kind of an independent, objective monetary standard that doesn't have the political influence of any particular nation behind it.
Yeah, powerful quote. And I think we're seeing that play out now. So, stores of value compete over certain attributes. While many goods have been used as stores of value or proto-money, certain attributes emerged that were particularly demanded and allowed goods with these attributes to outcompete others. And I'm going to run through these, the first ones quickly, and then we'll kind of get into a couple of the other ones. But this list is my benchmark. Again, for everyone kind of has a different take on what makes either store of value, median of exchange, or unit of account, or good money or hard money. This is my benchmark list. So durable, and so goods must not be perishable or easily destroyed. And that's why we don't use grass or wheat. Portable, this is why we don't use a cow, and we use things like maybe a gold bracelet or trinkets. Fungible. Thus gold is better than diamonds because diamonds are irregular in shape and quality. Verifiable, so you need to know that the good is authentic. Gold is, generally speaking, easy to verify, but I don't know if to validate might be a different story. Divisibility, so a good must be easy to divide, and that's why over generations, when we went through trying to figure out what was going to be money for human civilization, we went through a period where even gold and silver were together, because silver was more divisible than gold. But then we get into scarcity, which we talked a bit about with Nick Szabo, and unforgettable costliness. So in other words, the good must not be abundant or easy to obtain or produce in quantity. The ones I want to ask you about, though, is established history. And so, I think gold really is king there. But what does that really mean, or how important is that to us as we enter the digital era?
Yeah, so gold is, as I say in the article, gold is the king of established history, because gold has been used as money for thousands of years. And really, this plays into the game theory of money, where you want to use the money that has been used or is used by everyone else. And part of what feeds into that is history. You look back and you say, well, everyone's been using gold forever, so probably they're always going to use gold into the future. Except that advantage can be diminished fairly quickly, I think. And I make the point in the article that as something exists for a longer and longer time, there's this thing called the Lindy Effect, where you believe if it's existed for a long time, it will continue to exist for even longer. And I think people's trust in gold because of its history will be asymptotically approached by Bitcoin. What I mean is that people's trust in Bitcoin will grow very quickly over time. So in the first few years, people didn't necessarily trust that Bitcoin would stick around because they didn't know if the protocol was, solid, whether it worked. And then they didn't know whether Bitcoin was going to get regulated out of existence. There are a lot of worries about Bitcoin. But my view is that Bitcoin is going to be like the internet. 10 years after the internet was created in the early 2000s, people were like, oh, this looks interesting. Don't know how important or valuable this is going to be. But, it's something that could be useful to us. But go 10 years further to the 2010s. And I think by that point, most people recognized that the internet was hugely valuable and would be a permanent institution in the world. So I really think there's kind of this threshold. Once you get to something existing for around 2 decades, Bitcoin's about halfway there. But once I think it exists for another decade, I think most people are going to recognize it as a permanent institution in the world. And really people growing up who were born, say, in 2009, 2010, when they reach adulthood in the 2030s, they are going to look at a world where Bitcoin has existed their entire life, and they won't know a world without Bitcoin. So it's I think around then that people will start viewing Bitcoin in the same way they view the internet. Hey, this is always going to be around. It's too valuable, it's too important, and it's been around 20 years. There's no way it's going to go away. And I think that will really increase people's trust in Bitcoin as something that can be used as a store of value. And so that comparative advantage between gold and Bitcoin for established history, I think will narrow very quickly over the next decade.
Right. Yeah. And just to kind of build on that, the internet played out without the internet. So it took, I think, really more like 40 or 50 years for the internet to really play out from when, the military was building it out in the 60s and 70s, and then for email and universities. And I think that with Bitcoin, I think the reason it's going to I think it's playing out faster because it has the internet under it. And we're seeing everything just get faster and faster. And I think that's why money on the internet is going to play out faster than internet when it didn't have the internet to build on.
Right.
And another attribute that you name, which is a new attribute, which I'd love for you to explain, is censorship resistant. And how does that apply to Bitcoin, and what is that?
Right. It's the ability for money to be used without external interference. And that interference could come from a nation state, it could come from a corporation, or more typically a corporation working on behalf of a nation state. And that is the ability for some third party to say, you're not allowed to use your money in the way that you want to use it, and kind of censoring the transaction that you would like to do. And fiat money, so in my article, I compare Bitcoin to gold and to fiat monies. Fiat money is not censorship resistant at all. The system as a whole is deeply controlled by the nation state. And if it becomes the case that a nation doesn't want any particular person or group to use that money, it's very easy for them to create regulations that will make financial institutions block those people. So for instance, the United States makes it illegal for anyone who's Iranian to use the US banking system. And the US banking system is kind of connected globally to the world's banking system. So it makes it very hard for any financial institution around the world to allow Iranians to use their banking system. And that's really unfortunate, because it's not the case that Iranians are evil or immoral. Perhaps their government is, but it's really unfortunate that an entire nation of people is cut off from banking services. So that's an example where censorship can happen because the system is controlled by a government.
Yeah.
Now, gold is a little bit better because it's just kind of a commodity that you can hold, and if you want, you can transact with people locally. But gold is it's unfortunate. Its physicality creates certain disadvantages for gold, and one of the big disadvantages for gold is that it's kind of inconvenient to store and secure yourself, which is why historically people would put their gold in a bank if they felt safer putting it in a bank. And so you'd have this centralization of gold custody in these financial institutions, and that made it much easier for nation states to go and confiscate that gold. And that's what happened in the United States in 1933 when Franklin Roosevelt issued Executive Order 6102, which confiscated the gold of all private citizens in the United States. So gold's physicality is actually kind of a disadvantage for its use as money because it creates these problems of storage and security that people have to solve. Bitcoin, on the other hand, being digital, it's much easier to store very large amounts of Bitcoin if you wanted to. If you're a wealthy person, say in China, you could store 10, 50, $100 million worth of Bitcoin on a USB stick, or even in your head using, a seed phrase to represent your Bitcoins, the keys to your Bitcoins. So you could do it at very low cost, and the other powerful thing is you can cross borders with your wealth without anyone ever knowing that you're carrying that wealth with you. So it's a very, very powerful thing. If you've ever experienced crossing a border with your savings on you and not having to ask anyone's permission to do that, it's a very powerful feeling. And so for the attribute of censorship resistance, Bitcoin is head and shoulders above everything else.
Yeah, there's a lot to unpack there, especially on portability. Have you ever had to transport wealth over a border?
I haven't personally, but when I was a kid, this is a story I sometimes tell. My mother got sick, and my dad was raising my sister and I in Australia, and he got concerned about raising two young children in Australia by himself if my mother passed away. Thankfully, she recovered and she's doing great now. But at the time, he decided he would move his wealth back to India, where his family was and where his connections were. Under the assumption that he would want to raise us there. And there was no good way of transferring his savings back to India at the time in the early 90s. So my dad sold all the assets he had in Australia and converted the proceeds to gold. And he carried a bag of gold on an airplane back to India. And I vividly remember how stressed my dad was doing that, going through customs in a very corrupt country at the time. It's very possible that one of the customs agents could just ask for a bribe or take the bag of gold entirely. So I was already, when I first came across Bitcoin, I was already primed to understand its value proposition, the ability to transport or transmit value very easily across the world without having to do that kind of thing, carry a physical bag of gold with all of your savings, which at any point could be grabbed by someone. There's a huge advantage that Bitcoin provides over gold. And sometimes I describe Bitcoin as digital gold with the extra magical ability that gold doesn't have, that you can teleport it anywhere on Earth, because you can't do that with gold.
Right, yeah. Just ask the Venezuelans. I mean, around the time I read this article, they couldn't get several billion out of the Bank of England because the United States stepped in and wouldn't let the transfer physically happen. So, can you talk a little bit about the durability of fiat, like the British pound, the US dollar, compared to maybe the Zimbabwe currency?
Yeah, so the durability of a fiat currency is really strongly related to the sovereign authority that issues it. And if a nation state collapses, due to either internal politics or external duress such as a war being waged on it, then that currency will lose its value. So the durability is really tied to the institution that issues the currency, and there have been numerous nation states throughout history whose currency has collapsed because the nation state itself has collapsed. So historically, the British pound and the United States dollar are kind of anomalies in a sense. They've existed for a fairly long time. Although you could make the argument that the dollar and the US pound aren't really what they were in the past because they're not backed by gold as they used to be. So you could say the US dollar is only really 40 years old because the US dollar as we understand it today was created in 1971 when Richard Nixon closed the gold window and destroyed that convertibility of the dollar into gold. You should only consider the durability of a fiat currency as being the durability of the state that issues it.
And speaking of the States, so what happened with India and the rupee notes a couple of years back?
So I don't know a huge amount of the history, but what the motivation the Indian government had was that there were a lot of people holding on to these large denomination notes, the 1,000 rupee note and the 500 rupee note, that were acting in the grey market, as claimed by the government, and they weren't able to tax these people. They were holding these notes in large quantities and then trading with them when they wanted to outside of the tax regime. And the Indian regime essentially demonetized these notes and said, after a certain period of time, these notes will no longer be worth anything. You have to go and trade them in for smaller denomination notes, which what they were trying to do was make it even more inconvenient to hold large amounts of the rupee. Because if you hold 1,000,000 rupees in 1,000 rupee notes, that doesn't take up that much space. But if you hold a 1,000,000 rupees in 20 rupee notes, it takes up a huge amount of space and quickly starts becoming unwieldy and difficult to store. So that's a good example. I thank you for reminding me. It's in my article where the Indian government, without any external pressure, internally sort of destroyed the durability of their own notes because they wanted to tax their citizens more than they currently were. And they said, well, these notes that you hold, they're not worth anything anymore. So you've always got to be wary when the money is controlled by a political authority that they may do something like that. That may harm your savings, which is one of the big advantages of having a store of value that's not sovereign, not connected to a political authority.
Right. Yeah, I agree. And I think they're very good points. Kind of, we'll gloss over verifiability a little bit. We know that gold is not immune from being even counterfeited. You can have gold-plated tungsten. Divisibility, we've discussed earlier with gold, and that needs to be solved by silver, and gold is centralized. Bitcoin is practically infinitely divisible out to 100 millionth of a decimal. Scarcity, we've touched on. So speaking maybe about the evolution of money, how does money always evolve through 4 stages?
Yeah, so money, the way people think about money today is they think about it as a medium of exchange. It's the thing that they use to go and buy stuff at the grocery store. But really, medium of exchange is just one of the functions of money. Money has other functions as well. And one of them, which we don't think about it as much today because governments have really hurt this function, is store of value. Historically, people used money as a store of value as well. It's a place where you keep your savings with the understanding that those savings will retain their value over time. Now, if you look at how money evolves, there was this famous economist, William Stanley Jevons, who was one of the fathers of marginalist economics, which was a revolution in economics that happened in the 19th century. He said money evolves in stages. And the first stage is money is a collectible. It's valued just in and of itself. It's just something that people see and think, wow, this is cool, I want to have some. And that's really what gold was in the very, very earliest days of human society. People would see gold and think, this is a shiny rock. And I just want to hold it because I like the fact that it's shiny. It's valued in and of itself. And over time, as people saw that other people valued it, they recognized that holding some of it might be good because it's something that's valuable and that other people value and may hold its value over time and potentially could be exchanged in trade. Now, as a larger and larger group of people come to value that good as a store of value, it becomes suitable for use as a medium of exchange because you recognize that other people want to store their savings and their value in it. So I can complete my trade in it. So if I want to purchase apples and I'm a fisherman, I could, instead of using the fish because the apple grower may not want fish, I can use gold because I see that it's widely valued and probably the apple grower values gold as well. So all market-based monies start as a collectible. They move on to the phase of becoming a store of value. Once they're deeply established as a store of value, once they're widely valued by a community, the community can start using it as a medium of exchange. And then the final step in the evolution of money is once it's widely used in an exchange, once people are trading it back and forth to buy things, it becomes a unit of account, which is people will start pricing goods in terms of that money and thinking about profit and losses in terms of that money. So that's when you start seeing, the cow is 3 ounces of gold, or the loaf of bread is a hundredth of an ounce of gold. And you start seeing in grocery stores prices quoted in that medium of exchange. And that's the final step in the evolution of money.
Right. And I think to touch off on that, what I really got from this was just the value of not using Bitcoin as a medium of exchange. And you can look at the famous pizza story of a man trading 10,000 Bitcoins worth approximately, 500 million at this time for 2 pizzas. And what unit of account, I got 2 things out of this is one, I need to use unit of account. Bitcoin is my unit of account. But what you were just touching on with, things being priced in Bitcoin, for example, while a cup of coffee might be available for purchase using Bitcoins, the price listed is not a true Bitcoin price. Rather, it is the dollar price desired by the merchant translated into Bitcoin terms. And that was really important in like thinking about distinguishing between the two. It's like, so I could use this as my tool, but just because no one else is doesn't mean that the tool's not working for me to use it as my unit of account. And
Right.
and I think that's really important. And then, so the next thing I want to get into is a sort of path dependence. And what is monetary premium? And, and kind of like bubbles, and is Bitcoin a bubble?
Right. So monetary goods display something that I call a monetary premium. That is the extra value that can't be attributed to its utility alone. Gold has some utility in things like electronics, and it's used in fillings of teeth, so it has some dental usage. But that industrial usage of gold is actually tiny. It's only a fraction of what would explain the price level of gold. So the current price of gold is, I think, $1,700 or $1,800 an ounce. But if you looked at its industrial uses, that would probably only explain $100 or $200 worth of gold's price level. The rest of that is a monetary premium. People using that good for its monetary attributes or its monetary uses, such as a store of value. So most gold on Earth is not used for anything. It just sits there idle as bars of gold, bars of bullion in bank vaults. And so that is the attribute of something that is money. It has this extra value that can't be explained by the utility of that thing, but could be explained by its usefulness as money. So Bitcoin is really the first monetary good, which is pure monetary premium. It doesn't have that industrial utility. You can't use Bitcoin to fill people's teeth. You can't use it for jewelry. It's valued just for its usefulness as money, as a store of value in the future, as a medium of exchange. Path dependence is this idea from finance that people will look at the history of something, the price history of something, when trying to figure out whether it's expensive or cheap. So money is this thing which is path dependent, and people will often look at its price and say, well, it used to be, a Bitcoin used to be $50,000, but it's crashed down to $30,000. So that means it's cheap. And they're looking at the prior history as a way to gauge whether or not something is cheap or expensive. And this is a little bit hard for people to understand because Bitcoin and gold, they don't have an earnings stream, so you can't value them that way. So what is the real fundamental value? There is no formula that you can use. There's no discounted cash flow analysis you can do. So people sort of fall back to path dependence, where they look at the previous path, and that shifting path can change people's expectations. And it's really interesting. It's part of the game theoretic nature of Bitcoin that as the price starts going up and up, people will think, wow, Bitcoin's becoming more valuable. It is actually a more useful, valuable thing because it's increased in price. whereas the Bitcoin system itself hasn't changed. So yeah, it almost sounds circular, but it's a way that people reason about the value of money is to look at past history.
Yeah, this was a really big and important point for me because it helped me understand that I valued this more than other people. And it kind of helped me like think about something like dollar cost averaging and why the price is sort of irrelevant. And I'm going to read, a quote from well-known Wall Street fund manager, Josh Brown. I bought Bitcoins at like 2,300 and had an immediate double on my hands. Then I started saying, I can't buy more of it as it rose, even though that's an anchored opinion based on nothing other than the price where I originally got it. Then as it fell over the last week because of a Chinese crackdown on the exchanges, I started saying to myself, oh, good. I hope it gets killed so I can buy more. And you see that circular logic and you start realizing, well, up is good and down is good. And I can get in when I can. And on that note, is Bitcoin, like a religion in terms of how people evangelize about it or proselytize about it? And is that rational for Bitcoiners to want to tell other people about this thing that is scarce?
Yeah, so money is like religion in a sense that both are there's a technical term for this. It's called an intersubjective reality. It's something that is created and has value because everyone else believes in it, and you sort of live in a society where everyone else believes in it. And if they do all believe in it, then you can get value by sort of piggybacking on that institution that's been created. So, if everyone believes in the Catholic Church, that creates a reality that you are living within. If everyone believes something is money, then that is a new reality that you can use and gain value from. And it's sort of similar to religion in a sense that you'll see that when people adopt Bitcoin, a lot of them become almost evangelists, explaining to their friends and family, hey, maybe you should get into Bitcoin too because the price is going up and it's really good as a store of value because it has these properties that you can't get in other places. Like you can control your own savings, no one can stop you, you can transmit it to whoever you want. And they start evangelizing. So people have looked at this and said, well, Bitcoin's just a religion and this gives it an aura of irrational faith. But really, the spreading of a new money that's superior to an inferior monetary system actually is very rational, because a society that standardizes on a superior store of value and a superior monetary system has huge advantages to everyone in society, because it creates a new intersubjective reality that's superior to the previous intersubjective reality. It's almost like one religion, which had a bunch of irrational beliefs about, sacrificing humans or something like that, is replaced by a new religion where being charitable to your fellow man is taken as one of the highest beliefs. So that's beneficial to all of society. And the same thing is true for money. One money that's superior to another, that replaces another, is a rational end goal for society as a whole. So while it may look a little bit irrational to see individual people evangelizing as if it's they're part of a religion, if society standardizes on that new form of money that's superior, everyone will benefit.
Oh, yeah. Yeah, and I really got all of that from this piece, and that was a very important point. And so, you think about how there's no rules to how, a monetary good can get monetized. But there are, something called, what are Gartner hype cycles, and how do they represent like sort of the standard S-curve adoption?
So one of the things I found most fascinating about sort of observing Bitcoin over the last decade is that we can observe the process of monetization in real time. We've never, ever been able to do that. The process of gold becoming money took thousands of years, and you couldn't sort of observe the entire history in a short window of time. With Bitcoin, we're watching it happen over the period of a decade or a few decades, and we're learning certain things that we never knew about the process of monetization. And one of them is that money seems to get adopted in these cycles, and the cycles play out as kind of a Gartner cycle. And a Gartner cycle is this kind of pattern where you have a plateau of interest where the only people who are interested in the technology or the monetary good in the case of Bitcoin, there's just a few people interested, and the value of that thing sort of just moves along horizontally for a while. But then more people come along and say, wow, this has got some interest from other people. Its value seems kind of stable, and that drives the value up. And as the value starts drifting upwards, more and more people come in, and then the speculators come in, and they drive the price up very, very quickly into this climax where the price goes parabolic, and eventually it reaches the climax and it crashes. But it crashes down to a new level that's higher than the previous plateau, and that plateau persists for a period of time until you get into the next hype cycle. And the interesting thing about these hype cycles with Bitcoin is that if you take one of these hype cycles and superimpose it on the other one, the shape is almost identical. It's just bigger. So it's like a fractal of increasing magnitude. You take the 2017 Bitcoin bull market and you superimpose it on the 2013 bull market, and the chart is so similar, it's almost eerie. And the same is true now, today, actually, in the current bull market. You could take the current price action and superimpose it on the 2017 chart, and again, it looks almost identical. So we've learned that the process of monetization happens in a series of these hype cycles that grow bigger and bigger in magnitude over time.
Yeah, and that really kind of was an epiphany in the sense that I realized that we've never seen anything like this before. This is a once in a humanity event, and I think that is why I feel so important to evangelize, because it's you think about something like there's nothing new under the sun except for maybe Bitcoin. There's never been a new paradigm before, and one I want to ask is are these cycles inherent to the social dynamic to monetization?
I think so, and I think that's one of the things that we've learned. And the thing I found so fascinating is looking at these Bitcoin hype cycles. If you look at the price chart of gold from the late 70s, from the early 70s all the way to 2000, it fit this exact same pattern of a Gartner hype cycle. The chart looks almost identical. And so I think we can reasonably speculate that this is part of the inherent social dynamic of how monetary goods get adopted over time. It's just that gold is so much bigger, and the hype cycle took much longer. It sort of went over a period of decades, whereas with Bitcoin, it's happening much more quickly, both because Bitcoin is smaller and because we live in a digital age when information can move around much more quickly and people can understand the value proposition much more quickly.
Yeah. And I think another point there is just that, these cycles have hype and exhaustion, and very few people, and these are your words, very few people participating in an iteration of a Gartner hype cycle will correctly anticipate how high prices will go in that cycle. Prices usually reach levels that would seem absurd to most investors at the earliest stages of the cycle. When the cycle ends, a popular cause is typically attributed to the crash by the media, while the stated cause, such as maybe an exchange failure may be a precipitating event. It is not the fundamental reason for the cycle to end. Gartner hype cycles end because of an exhaustion of market participants reachable in the cycle. And that was really important to me to frame up, because I came into Bitcoin at towards the end of 2017, at the end of what I think is now a cycle, and we'll get into where the cycles are and which cycle we're in. But that was kind of very important for me to frame up what just happened, what does happen when these things, and sort of these other standard S-curves around internet or email or the fax machine, and watching them go through the same thing. But like I said earlier in the show, I think everything's just happening faster. But to have that historical examples was important. And you outline these kind of cohorts. So, we look at these 4 cycles that you've already outlined, and you wrote this article 4 years ago now, or 3 years ago. So, from $0 to $1. And during that cycle, the Bitcoin market was dominated by cryptographers, computer scientists, and cypherpunks who were already primed to understand the importance of what Satoshi Nakamoto was solving with the white paper. And you can understand why it's not widespread at that point. And then from March 2011 to July 2011 is from $1 to $30. And this is where you got the early adopters of new technology and a steady stream of ideologically motivated investors who were dazzled by the potential of a stateless money. So again, still not a very wide network. And then you have that third cycle from April 2013 to December 2013, $250 to $1,100. And this saw the entrance of maybe some early retail and maybe a few institutional investors who were willing to brave, the very complicated and illiquid market that it was back then. And then we really get into what everyone knows as the last cycle, or the fourth cycle, which is somewhere around 2014, 2015, or 2015, or however people want to cut it off, from $1,100 to about $20,000. That was kind of like the early majority of retail and institutional investors. And we're all familiar with that, but it seems like we're in a fifth cycle. And my question for you there is this the fifth cycle of 100 cycles, or is this like the fifth cycle of 6, or is this the fifth and final? And I'm not really getting into so much for you to prognosticate on the investment thesis here, but just where we are in Bitcoin, because at some point maybe this thing does reach an equilibrium where it's got wide adoption. So where do you think we are?
Yeah, that's a great question. And I think if you look at the adoption of different technological goods in history, they have this S-curve of adoption where eventually they reach this critical point where adoption grows almost vertically and goes from a small group of people to the majority of people fairly quickly. And I do feel like we're close to that threshold, maybe, and we're not quite there yet. Maybe there's 2 or 3 more cycles, but I certainly don't think there's 100 more cycles. I think the final hype cycle, when it happens, will be nation states adopting Bitcoin, and I do see that's going to take some time because nation states move much more slowly than individuals move. So I expect that we're at least 2 or 3 cycles away from what I would consider widespread adoption across the world. And I view Bitcoin's adoption as a 20 to 50 year project that'll take that amount of time before it becomes widely used across the world as a store of value.
Yeah, I agree. What is hyperinflation and how is it affected by faith?
So hyperinflation is when a government loses control over its monetary system, and mostly because it's started creating money far too quickly, and people within the nation lose faith in that money. And one of the typical symptoms of this is people treat the money of their nation like a hot potato. As soon as you get the money, you want to get it out of your hands really quickly. And I have a story from a friend from Argentina who grew up in Argentina, and he told me that when he was growing up at the grocery store, there was someone who would move around the grocery store putting prices on items at the grocery store. When they got to the end of their sort of long line of pricing, they would go back to the start immediately, because the price of things was moving up so quickly that if they didn't reprice them, the grocery store would be losing value. So in a system of a monetary system which is hyperinflating, you will get money and you'll get rid of it as quickly as possible because it's been created so quickly. Its value is decreasing incredibly rapidly. So a classic image of this in the Weimar Republic is people walking around with wheelbarrows full of cash to buy regular day-to-day items because the money had lost so much of its value.
Wow. Yeah, it's a striking image. And we talked about it earlier, how Bitcoin crosses borders seamlessly. It's digital. And that makes the competition for savings global now. And that was an important point where is the interest in Bitcoin going to come from? And we've kind of talked a lot about different the ways stores of value compete. So we've noted that. But also, I think just the notion that savings is up for grabs. Not just around the world globally, but from any vertical where savings is sort of being stored now, whether it's real estate or stocks, bonds, what have you. But I do want to get into some of the common misconceptions. And we've talked a little bit about, whether Bitcoin was a bubble and how money works and evolves. But one I want to ask you, is Bitcoin too volatile?
Yeah, this is a common criticism people have when they first come across Bitcoin is that the price seems to move around a lot. But really, this is what you would expect from something that's becoming money and has a fixed supply. Uh, as savings moves into Bitcoin, its price is going to rise very quickly in the early days when it's small. When it was first created and there was basically holding any Bitcoins, anyone sort of buying 1,000 or 2,000 Bitcoins could move the price quite a lot. So an example is the Winklevoss twins put $10 million into Bitcoin in 2012, and that dramatically moved the price at the time. But now today, because Bitcoin is much bigger, if someone were to buy or sell $10 million of Bitcoin, it would barely move the price. It would, move 0.5% or something like that. And really, it's Bitcoin's volatility is a function of the savings that are flowing into Bitcoin. As Bitcoin becomes bigger and bigger, the savings flowing into Bitcoin will have less of an impact. So the way I think about it is nothing can go from being worthless to being $1 trillion asset without volatility along the way. It's just absolutely impossible. And Bitcoin is in the process of being monetized. So the world's savings are flowing into Bitcoin as a store of value. And that volatility will diminish over time as the flow of savings starts to slow down. As most of the savings are already in Bitcoin, the amount of savings that will want to sort of flow into Bitcoin will diminish relative to the size. And so the volatility we will expect will diminish as Bitcoin becomes more and more widely adopted.
Interesting. And another one that people raise is competition we've been talking about. So can Bitcoin be copied?
Yeah, so Bitcoin is an open source protocol, and the software can be copied, and even the blockchain can be copied. So it can be copied, but what can't be copied is the network effect of Bitcoin. The fact that people are using it for savings, and there's a large community of developers and businesses and these sorts of things that are already built around Bitcoin. That part can't be copied. It's just like Facebook. You could say Facebook is a fairly simple website. You could create it and call it Cedric Book, but that doesn't necessarily mean that you're going to get a large number of users because you don't have the network effect of everyone else being on Facebook. And so new people want to be where everyone else is. So for any good that has a network effect, the network effect is the most important attribute or feature of that good. And money is one of the economic goods which has the most powerful network effect. You want to be using the money that everyone else uses.
Right. Yeah, I agree. As Robert Breedlove said on this show, you could fork the rules of chess, but no one's going to play with you. Good luck.
That's a good way of saying it.
Yeah. So, what are the real risks then to the Bitcoin protocol?
In the beginning, protocol risk was probably the biggest risk. Satoshi had created this new protocol for value transfer, and it wasn't clear whether he had actually succeeded or whether he had a flawed design or there's some major flaw. And people weren't convinced in the beginning, but over time, we've sort of come to believe that the protocol is rock solid, and any flaws it had in it, because it's an open source system, have been exposed and have been fixed. I think probably the biggest threat to Bitcoin at this stage is nation state attack. That is, some nation or collection of nations saying we need to ban Bitcoin because we don't want to allow our citizens a tool where they can transact with each other and save without our permission, or they fear losing control of their monetary policy because the world's savings flee into Bitcoin and they no longer have the ability to inflate the money supply anymore because all that savings is in Bitcoin. The question for me is whether Bitcoin gets enough political capture before a nation state attack happens in any serious way. And what I mean by that is, if you consider the company Uber, the ride sharing service, they would go into cities around the world and start their business, even if the cities were kind of hostile. And they would quickly get a base of users and drivers who really love the product. And so when the city started to crack down and the taxi lobby lobbied the city to say, you need to get rid of Uber, there was enough of a political lobby fighting for Uber to keep it open and to keep it growing. And I think the same thing is happening with Bitcoin as well. The number of people who are using Bitcoins as a means of savings is growing fairly quickly. And I think in this next cycle, it's going to grow dramatically. And so what you'll see in, for instance, the United States is that you'll see people in Congress who are much friendlier towards Bitcoin because their constituents hold Bitcoin. And you already see members of Congress, a handful who are very pro-Bitcoin. I think that's going to increase a lot over the next 4 years. And it'll get to the stage where, like 401ks, there's no way the government could ban 401ks because millions, tens of millions of Americans hold their savings in 401ks, and they would be rioting on the streets if the government said, well, we're going to confiscate all these 401ks, we're going to ban 401ks. Or the internet is another example. You simply cannot shut down the internet because the value it provides across society is so tremendous that people would not tolerate that happening. So I think it's an open question of whether Bitcoin gets enough political capture that it becomes invincible in a sense, politically untouchable. I still think that's an open question, but I'm very encouraged that at the rate at which Bitcoin is adopting, it will become politically untouchable over the next 4 or 5 years.
Wow. So what conclusions can we draw? Can Bitcoin become global money? What would that be worth? And, what is this an asymmetric bet?
Yes, so I am thoroughly convinced that Bitcoin is on the precipice of becoming inevitable as a global reserve currency to the point where it can't be politically attacked anymore because it's adopted by enough of the world's population that governments won't be able to stop it. If Bitcoin were to become the world's reserve currency in the same way that gold was the world's reserve currency in the 19th century, then each Bitcoin I think is going to be valued in the order of tens of millions of dollars. So it will be dramatically more valuable than it is today. So the upside is still massive, I think. The downside is that, whatever money you put into Bitcoin, potentially it could go to zero. I think that risk is much, much lower today than it was in the past, say in 2012 to 2015. So, if you think about it in terms of a bet, your downside is 1x your investment. So you put $100 in, you could lose $100. But I think the upside is still at least 100x. So that's what you call a classic asymmetric bet. The upside could give you 100 times your returns. The downside is potentially 1 times your returns. So as an investor, it's usually a good idea to look out for some of these asymmetric bets, and you don't necessarily need to throw your entire portfolio at them, but some small fraction of your portfolio totally makes sense because an asymmetric bet can have a huge impact on a portfolio if it pays off. And people in Silicon Valley are very familiar with this. All of their investments are asymmetric bets. They're all angel investments. Invest in things which are early and potentially could become big, like Uber or Google or Facebook. They invest in these things when they're young. And I think Bitcoin is still very young. The addressable market for Bitcoin is massive. The global market for stores of value is in the order of hundreds of trillions of dollars, and Bitcoin is still only worth about 1 trillion. So I think Bitcoin still has a long way to go, still a very large addressable market to saturate. So I'm still very bullish on Bitcoin. This is 3 or 4 years after writing that article.
Yeah, I was going to say 100x. Why so bearish, Vijay? I'm kidding. So I have one more question for you. So I'm just going to read 2 quotes from the article, and we'll get into the final question. The adoption of Bitcoin as global money is precisely the bullish case for Bitcoin and was articulated by Satoshi Nakamoto as early as 2010 in an email exchange with Mike Hearn. If you imagine it being used for some fraction of world commerce, then there's only going to be 21 million coins for the whole world. So it would be worth much more per unit. This was the case made even more trenchantly by the brilliant cryptographer Hal Finney, the recipient of the first Bitcoin sent by Nakamoto shortly after the announcement of the first working Bitcoin software. Imagine that Bitcoin is successful and becomes the dominant payment system in use throughout the world. then the total value of the currency should be equal to the total value of all the wealth in the world. Current estimates of total worldwide household wealth that I have found range from 100 trillion to 300 trillion. With 20 million coins, that gives each coin a value of about 10 million. It just makes me think that Hal really thought deeply about this long before Bitcoin was announced. I'm blown away by his conclusions that early on and his conviction. So my final question to you is, what is the non-financial case for Bitcoin?
I guess there's the moral case for Bitcoin, and it's one of the reasons why I became very interested and excited about Bitcoin. I love the idea of the world being on a non-political monetary standard, one that isn't controlled by any nation state, and when no particular nation can censor or prevent people using money as they see fit. And as a libertarian, that's really important to me. One of the reasons that central banks were created historically was to fund warfare. The Bank of England was created to fund a war against France. And so nation states will have to, under a Bitcoin standard, they won't be able to inflate their money supply to fund warfare. The only way they can fund warfare is through direct taxation. And direct taxation is almost always politically very unpopular. And there's some amount of pushback when you're taking money directly out of people's pockets. So I think really the potential for nation states to wage warfare on each other will be dramatically diminished. And that's something that I'm very excited about. I also really like the idea of savings becoming cool again, moving towards a society where people are excited to save because the money in which they're saving it in is fixed in supply, and they know that over time it's going to rise in value. I think that has very profound impacts on the moral state of society. Instead of consumption-based and ostentatious consumption, you move to a society where people are much more frugal and they value savings and they live within their means. And I think that's a really good thing for societies in general.
Yeah. I can't tell you how much, your piece meant to me or means to me. It's still to this day the first piece I share with people, from my mother who's 79 years old to my brother-in-law to people at the office. For me, it really just summarizes so well the value proposition, both financially, but also morally, and what we're going through. And it cut through a lot of noise for me in terms of, Bitcoin could be information overload at first. And it really distilled so much in such a great format. 40 minutes, it's digestible. You could do it on lunch break. So I never thought this conversation would happen. I want to thank you so much for coming on the pod. I'll leave it to you for any parting words, and definitely let people know where they can find you. And I love the block clock behind you, the Bitcoin.
Awesome. Well, thank you for the kind words, Cedric. I really appreciate that. People can find me on Twitter. That's probably the best place to find me. I tweet a lot about Bitcoin and economics. And I'm real_Vijay on Twitter. So REAL_VIJAY. And also just wanted to mention the Bullish Case for Bitcoin will be coming out as a book soon. I've updated it. There's some things that have happened in the last 4 years that I think were worth writing about. I've expanded it a little bit, so it might not be a 40-minute read, but probably less than 2 hours. And it'll be in book format. It'll have some beautiful artwork in it as well. So I I'd love to send you a copy when I've finished, I've almost finished writing, and hopefully we'll have it published within the month.
Yeah, I'm very much looking forward to that, and I'd love to have you back on and talk about it. I'm sure there's going to be a lot of interesting new points in there, and book form, it's going to be great. So I'm very excited. Thank you so much, Vijay. This has been so awesome. Thank you.
Vijay Boyapati on the 4 stages of monetary evolution, path dependence, and the bullish case for Bitcoin, right here on the Bitcoin Matrix podcast. And thank you for listening. If you dug the chat, please subscribe, rate with a 5-star review, and share a link to the show with your friends and family. And if you need to start stacking sats or want the best place to DCA, plus get $10 of Bitcoin free on me, just sign up at swanbitcoin.com/Cedric Youngelman. That's the best way to get started. This is Cedric. Peace.